tools. We're going to look at a lot of concepts and tools regarding the valuation of a stock or an equity security, right? We'll compare it to the market price, and of course the market price, if it's lower than the intrinsic value or the estimated value, we should buy it, and vice versa, if the market price is higher, we should sell it. How do you calculate that estimated value? What are the different models you can use, such as the dividend discount model, such as the free cash flow to equity model? How do you go about valuing a preferred stock? What is the Gordon growth model? What if the dividends are growing in multi-stages, right? What are multiplier models? How do you do this based on price multiples? What is the value of the entire enterprise, and how do you go about doing a asset-based valuation? So very, very important learning module, not just for your CFA level 1, but just generally in financial markets. The equity market is a major part of the financial markets, and equity valuation is a major component of that. Right. So far, what have we talked about? We've talked about how securities markets are organized, how efficient they are, how inefficient they are, what are the behavioral biases, how does one go about doing the projections of a company, right? So let's say a company has common stock, preferred stock. The common stockholders will only get money if the company has positive cash flows and it is able to share that, right? So that really depends on what will happen to the industry in which that company is operating. But the question is, once you've calculated or projected the future cash flows that a company is going to have, how do you convert that into the intrinsic value, right? That is what the focus of this learning module is going to be on. So, how do you go about doing this? How do you estimate the value of the security? And then what do you do with it? If you find that the market value is greater than the intrinsic value, then the security is overvalued in the market, you should sell it. Vice versa, if the market value is less, you should buy it. And if it's fairly valued, well, there's not much of a trade there. If you already hold it, you can just keep it. So, if the market value is not equal to the intrinsic value, you can think of buying and selling, right? But before you do that, just consider that, is the market ready to reprice, right? So maybe it is currently, you feel the intrinsic value is 100, it's currently trading at 50. But what's the reason that the market is not pricing it at intrinsic value, especially if the market is efficient? And is the market ready to now price this to its proper value? How did you come up with this intrinsic value? Who are the other analysts who are covering it? Are they also coming up with the same intrinsic value, or are you taking some assumptions? Is your model sensitive to some assumptions? And are others taking different assumptions for the same things, right? So how much confidence do you have in your model? And what is the percentage difference? If it's just a small difference, then okay, maybe that's plausible. But if it's a huge difference in the market price and the intrinsic value, well, maybe we're missing something out. Or maybe we're not. Maybe there is a good opportunity. So you need to consider all these factors. Now the question is, how do you go about doing the valuation? We're going to look at 3 basic models, and then within your DCF, we will look at various different types. But DCF is basically discounted cash flow, right? So you could either take your cash flows, future cash flows till infinity, and try and bring them back to today. Of course, that's not a very practical thing to do, because I mean, you'll just spend the rest of your life doing the projections of cash flows and discounting them back. So what we use is something called a terminal value, that at some point we have to know that, okay, we're not going to do the projections of cash flows from this point onwards, right? But if the cash flows stabilize, or if the growth of the company stabilizes after that point, what is the company worth at that point? And then you just bring back the terminal value to today. And of course, if there's interim cash flows until you reach that stable part, then you discount back only those cash flows as well. And this is something very, very critical to this entire learning module, which is called the Gordon growth model, which helps us calculate that terminal value. But like I said, and let me just write down the formula. So let's say if the cash flow is a dividend, right? And it's going to reach that dividend after 10 years, which we can say is that now it's stable. It's going to grow at a stable rate. So what is that stable rate? And you take the required return on equity and you minus from that the stable growth rate, and it will give you the value 1 year back. So this is basically something very, very important, that once a company reaches that sustainable growth rate, then only can you use this Gordon growth model to calculate the terminal value, and then you can then bring it back to today. And if there are any cash flows coming in those 9 years, you can bring those back to today as well. And this is all called the discounted cash flow model or a present value model, and we're going to look at that in detail. Another way of going about this is, let's say you want to know how much a company like Lyft is worth, right? You know the earning is X dollars or X pounds or X euros, right? And then you want to know how much it should be worth. So you compare it to a similar company, right? And you see, okay, Uber is also a ride-hailing company. For every dollar of earning, Uber is trading at, let's say, $10 per share. So if Lyft should be having a similar multiple, right? And that is just one multiple. There are other multiplier models. I'm giving you the example of price over earnings or PE ratio. But there are other price multiples that you can do, such as price over sales, price over book value, and so on. But this is basically a multiple. Price as a multiple of earnings, price as a multiple of sales, etc. So I say if Uber is at a 10 times multiple, then Lyft, if its Lyft's earning is, let's say, half a dollar, then it should be trading for 5 times, because that is $5, because that is 10 times its earnings, given that companies in this sector trade at that multiple. So that's another approach, a relatively quick and dirty approach. So much easier to do, but not so efficient. The most accurate, technically accurate, is the present value model, but of course it takes time, right? I mean, coming up with the future cash flows, even if you're not coming up till infinity, even if you're coming up till, let's say, the 10th year, when that stable growth rate is being reached, that's still a lot of work, right? I mean, doing projections for 10 years. And then you can do asset-based models. These are more relevant for banks, because see, the point is, if you're doing an asset-based model, you're saying, okay, this is the asset of the company, this is the liability, and this is the equity. And the equity value is basically whatever my assets are worth minus whatever my liabilities are worth. And therefore, the value of the equity of this company is 20. But then that really depends on how accurate the value of the asset is on the balance sheet. If the assets are measured at historical cost, or if a lot of internally generated intangible assets are not even showing up on the balance sheet, well, you can't really use an asset-based model then, can you? But for banks, why it is still relatively appropriate to use this, because majority of their assets are actually shown close to fair value on their balance sheet, because it's one of the requirements for them to try and keep their balance sheet as realistically presented as possible, because they are heavily regulated industry, right? So again, I mean, the choice of the model depends on what you're doing, what is the current situation, how appropriate the model would be for that particular situation, how confident you are in that model, right? And then of course you can use all three or more than one at least, and then try and take an average value. So now focusing on the present value model or the dividend discount model, which is the discounted cash flow. These are all discounted cash flows that we're going to try and come up with future cash projections and then discount them back to today. That cash could be dividends. So let's say the 10th year dividend divided by R minus G will give me the value of the company at the 9th year. This is the Gordon growth model. We'll talk about that shortly. But before we get to the Gordon growth model, we have to talk a little bit about the background, right? What is a dividend? A company gets money from equity providers, right? Debt providers, and it does some business. It's going to invest in some assets, and those assets are hopefully going to generate some income for them. They're going to pay interest to the debt providers, and if they want, they can pay dividend to the providers of equity. Now, what is the difference between cash dividend and stock dividend? stock dividend is not paid in cash. It is giving them more shares. Now you might be thinking, what's the use of that? So think about it. Like if there's one person who has 100 shares of this company, and then they get another 10 shares, so they are able to increase their wealth, right? And technically, they're not really getting money. They're just getting pieces of paper. But why companies do that is because what will happen is that if let's say this company had a total of 1000 shares, of which 100 was with this person. Now, if they're having 10% more shares being given to everyone, so then the entire total number becomes 1100, right? And if the entire equity of the company was, let's say, 1000 million, but then when there's 10% more shares and that 1000 million gets divided across 10% more shares, then the value per share comes down, right? The price per share should get negatively impacted. So this is a way of not just kind of trying to please the shareholders in a very silly way because they're not actually getting any cash, but also another way of keeping the share price down, right? So not very useful because there are better ways of keeping the share price down. You can do something called a stock split, right? Which means that instead of just increasing 10% shares, you could just double the number of shares. If you do a 2-for-1 split, then everybody will get twice as many shares that they had before. So the 100 would become actually 200. And in that case, if 1000 is divided by 2000, the stock price becomes half. So, and that's what Google, Microsoft, Amazon, all these big companies do when they want to keep the price down, that instead of doing stock dividends, they would just do a stock split. That is, it's basically like a 2-for-1 stock split is like a 100% stock dividend, right? Because for each one, you're giving another one. But what's really important is to understand that when we talk about a company taking money from shareholders, it's not an obligation to give them a cash dividend, right? It's something that has to be approved by the board of directors, and they might not approve it for two reasons. Number one, they might not have cash to give, and number two, there are other ways of giving shareholders money back. And I'll just come to share repurchases shortly. I just want to explain to you what is the difference between regular cash dividends and extra dividends or special dividends, and then I'll talk more about share repurchases. So if a company like Coca-Cola, let's say, is giving dividends every quarter, it's like a religious thing for them. So that is what we call a regular cash dividend. Why some companies don't like regular cash dividend? Because investors get used to them, right? So then one time if you miss them or you're unable to pay in a certain quarter, then it gives a really bad signal. So a better way is that some companies just prefer to give dividends when they have good earnings and good cash flow, but they don't make it a regular feature so that investors don't get used to it. Now, the point is that a lot of companies actually do share repurchases now, especially the newer ones like Tesla. Some even have a no dividend policy. Now you might be thinking, then how am I going to make money? I mean, if I'm investing in, let's say this is Tesla and I'm investing in the shares, I'm investing in their equity, then how am I going to make money if I'm not going to get any dividend? And that's a very valid question, because I was telling you that the whole value of the company based on the Gordon growth model that I was telling you is based on what the dividend is, or it's going to be once it stabilizes. But if there is no dividend, then what do I use? Well, I use something called free cash flow to equity. And that is something we will talk about shortly as well, that how you can value a share not based on the cash that you will get as dividends, but also on the basis of how much cash is there free in the company which is available for equity holders, right? So that's number one. And why is that free cash something that we are using to value ourselves at? Because even if the company is not paying me dividends with it, what it could do with that free cash is it could buy back the number of shares that we have, or at least a large number of shares from us. Now, how does that help me? Now, think about the multiplier model that I was saying, that Uber is trading at 10 times every dollar that they are earning. So the stock is at $10 if the earning is $1, right? And how is this earning per share calculated? This is something that ties in with your financial statement analysis material, that you take your net income, you minus your preferred dividend, and I'm talking about basic EPS here, divided by net income minus preferred dividend divided by the weighted average number of shares outstanding. So now if a company has free cash flow, right, let's say Tesla or Uber or whichever, let's say Tesla is trading at 10 times its earnings, right, and Tesla has taken some money from us as investors. It has a lot of free cash flow which is available for equity providers, which is called FCFE, and we'll talk about what it is. And we have talked about it in FSA as well, in your financial statement analysis area, that it can use this cash to buy back some of the shares. So if there's 100 million shares outstanding, it can buy half of those back, and now there will be 50 million shares outstanding. And if my denominator in the EPS calculation goes down and the income of the company is not changing, this cash is available free. Paying that out is not going to impact the business. So income stays the same. So what happens to my EPS is the denominator is going down, but the numerator is staying the same. Of course, it's going to go up. And if the denominator in this equation goes up, right? So for every dollar of earning, the share price is 10. And if this, let's say this dollar of earning becomes $2 of earning, and this ratio of 10x stays the same, then the share price goes to 20. And as an investor, I'm very happy because my share doubles. So that is how companies can pay cash back or value back to their investors, is instead of giving them a cash dividend, they can give them a value through purchasing back shares, reducing the number of shares, and thereby increasing the earning per share, and then thereby pushing the value of the stock up in the market. And there are other factors as well. It's not just that you choose between share buyback or dividend, whichever way is better. Share buyback is actually better than dividend in a lot of ways. Number one, most important, I would say, is tax efficiency. Because see, if let's say you are also an investor in Tesla, I am also an investor in Tesla, right? But you don't need the dividend right now, and I need the dividend right now. But if Tesla will pay, both of us will get it. If they pay a dividend, both of us will get it. Which means when you will get that dividend, you will have to pay tax on that income. And you didn't even want it. You just wanted Tesla to either reinvest the cash that they have in the business, or if they want to pay it out, they can use it to buy back shares, and your share goes from 10 to 20. My share also goes from 10 to 20, and if I need some money, well, I can sell some of my shares. I can manufacture my own dividend, and I can declare that gain and pay a tax on it. Whereas you don't have to sell your share, your wealth is going up, but since you're not selling it, you're not booking that gain, so you don't have to pay tax. And your money just keeps growing. So number one is tax efficiency, right? Number two is that when a company buys back its own shares, it's signaling to in the market that the company feels that the shares are undervalued at 10, they are pushing them up, right? So that's a good signal as well. Another thing is that it's not sticky. Like your regular cash dividend is sticky, people get used to it, right? Share buyback is flexible. It's like whenever you have extra cash, you can buy back, and whenever you don't, well, you don't have to do it. And it helps you absorb increase in outstanding shares. So it's not like the company is just buying the shares back and the number of shares are going down. A lot of the times what happens is new shares are also being issued, especially because of management, stock options and stuff, right? So that increase would then dilute my earning per share. If my income is the same, denominator is going up, then my earning per share would come down, and I don't want that. So if it's going up because of new shares being issued, but it's going down because of shares being bought back, so at least my value stays intact, right? So a lot of benefits for share repurchases. All right, dividend payment chronology. Now, if somebody is paying a cash dividend, how does that play out? So first of all, what will happen on their asset and liability and equity on their balance sheet? What will happen? They'll have some cash here, and let's say they announce we are paying a dividend. So see, let's say they've made some profit and it's with them available in cash, and that profit has increased your retained earning and your cash. Now they want to pay this cash out to your shareholders because their earning has been retained in the business and the company wants to pay it out. The minute they announce the dividend or declare the dividend, the amount will go from retained earning and it will get added to a liability called dividend payable, because that amount is now a liability. It is not equity anymore. You've already announced that you're going to pay it out to shareholders and it's a liability for you. But it doesn't get paid yet. It will be paid on the payment date. Until then, it is a dividend payable. Now, what happens from the declaration date to the payment date? See, we need to know who the shareholders are. If it's a public limited company, there could be hundreds of thousands of shareholders. So what will happen is that on the declaration date, we will announce what is the record date. And because financial markets, especially stock markets, operate on a T+2 settlement, so 2 days before, right? So this is 2 days before the record date, whoever's name is appearing on the register of the company as owners of see, basically the way it works is, if you buy a share here, it will take 2 days for your name to show up on the register. So if you want it to be showing your name on the record date, you need to buy the share at least 2 days before or before that. Because after this date crosses, which is the X date or the X dividend date, even if you buy it over here, it's going to take 2 days for your name to appear. And on the record date, it will not be showing. So on the X dividend date, the stock will drop in price. So practically the way it happens is, let's say it's trading at 100 and the company announces that we're going to pay a $2 dividend, right? So whatever the stock price is, up, down, on this particular day, the next day it will open at $2 lower. Why is that? Because if somebody buys it here, they will get that $2 dividend. If somebody buys the stock here, they're not going to get that $2 dividend. So at least they should get a reduction on the price. So that's what happens. And then of course, whoever's names appear on the record date, then on the payment date, they get paid. Right, let's take a break here. Then we'll come back and get into what is the dividend discount model. And if a company doesn't pay dividend, then how do we use the free cash flow to equity to value their equity?